or things that you're thinking of that you'd like to hear us do vlogs about, or where we're going with this Hyperwave project that we're all in the middle of? Anything, let's just open it up and have fun.
Yeah, and guys, so the impetus is that we would love to do more of these webinars, right? So like a full one on Consensio, and then make it even more full into like workshops of like 6 hours of intense on Hyperwave, etc. But the thing is, I suck with Zoom and I need to be a little bit better at this. It's super complicated. So thank you for being guinea pigs. You guys are the best. So let me know what sucks. Sent a Q with Q&A. Thank you, David. Yes, gonna check it in a second. So this is really helpful. So thank you guys. All right, Mr. Tyler, would selecting assets to buy based purely on Consensio and Hyperwave be a good place to start building a portfolio from scratch and then slowly ease myself into using other indicators?
Wow, that's a great question. And normally I would say no, it would not be, because we don't get enough hyperwaves. In fact, if you guys hadn't found all of these hyperwaves everywhere, I would still think that they're very rare. I'm beginning to expect that maybe if we did the same kind of research with historical data, we could find that there are many, many more hyperwaves back in 1995 to 2000, back in Japan in 1985 to 1990, that sort of thing. But in any case, I'm convinced that there's enough hyperwaves floating around right now that you could use that as an anchor to build a portfolio. Now, by definition, that portfolio is going to be very, very volatile. As you get closer to phase changes, or if price starts getting down close to a phase line, you all know from looking at these charts what happens. And I'm not sure that's a smart way to build a portfolio. I like to think of individual hyperwaves as 15% of a portfolio. And a number of you are also consulting clients with us. And you've heard me say over and over again that 60% of a portfolio should be broad indexes. 25% should be sectors and industries, and 15% should be individual stocks, either in hyperwaves or that have some fundamental characteristic where you can invest. And all of that together equals 100% of X, which is the money you've got available for portfolio. So basically what you're asking is, can I start building a 15% of my portfolio looking for hyperwaves as an anchor to learn technical analysis, and then use Consensio to time movements in and out of those? And my answer would be yes, that would be great. But I know that's not what you meant, and that's not what most investors want to do. They want to find a hyperwave and put 50% of their money in it, or find some red hot thing that's really working. That's just a natural tendency. If Hyperwave has the predictability that I believe it has, and I think many of you are finding, you've got to also admit it's got a unpredictability, not so much about what the overall design is going to look like, but what happens within the design. Very short phase twos, no phase ones because it's a new company, very steep phase threes. Is this really a phase 5, or is it still part of what I mistook as phase 4, and now we're only rejiggering the phase 4 angle? All those kind of questions will come up. Every once in a while, somebody will find a hyperwave that's just archetypal, just beautiful, and but most of them are weird in some ways before you even get to the funkiness of them. So the reason I'm saying all of that is I still believe that the proper investment technique for the next 10 years, 20 years, 30 years of your life is to use Consensio on major market indexes that are very liquid, very predictable, because Consensio lets you get in a little at a time, get out a little at a time incrementally, but then make big, big shifts between trend changes. And those indexes are always there and they're always moving. Therefore, that should make up a very broad, diversified portion of your portfolio. Now, if you want to cheat a little bit and use money out of the 25% with the 15%, now you've got 40% of your portfolio that you could put all into hyperwaves and call them all sort of an industry. In other words, all things that have commonality, but many different pieces of it, where you could pick up 10 or even 15 different hyperwaves and then apply Consensio to it. That to me is a pretty good start to learning how things actually work, and then add on to it all the other technical things. So that was a great question. I hadn't really thought about it in those terms, but that's why I rambled on, as I tend to do.
Knowing that hyperwaves return back to where they started, what does this mean for the very long term of Bitcoin, such as its ability to become a global reserve currency or to finally reach a stable price?
Another great question that I've wondered about over and over again. Everybody's concentrating on the last $5,000 down on this hyperwave in Bitcoin, and then the next 100,000 or 250,000 or 500,000 up on the next one. But for me, the bigger question is the one that you just asked. And my only answer to that that's satisfactory to me is that this could turn out to truly be an S curve and not a hyperwave this next time around. I think, when you think about hyperwaves, they're very depressing, because all of these great ideas that turn into great companies and great innovations are all doomed to fail and go all the way back to where they began, which is it's kind of the life and death thing of people. The first half of your life is all exciting and fun, and you don't think about the last half of your life. And then you get into all these theological and ontological questions about who am I and where am I really going, and is this really all there is? That's what hyperwaves are, in a sense. But in the real world of investing, you get things that are so significantly important to the world that they don't go away. You've got things like General Electric, which is, to me, very depressing, because here was a great company that was in a hyperwave back in the 1920s, never went into another hyperwave really, but is just slowly dying, as almost every company does at some point, or they break apart, or they merge with somebody else, or they are replaced with newer innovations and can't get out of their own way. Like Xerox is a great example. And then they come back and they do stupid things like, try to come out with their own coins because they've lost everything. Eastman Kodak is the same way. As soon as digital photography came along, it killed, many, many, many great companies. Now, in the world of autos, the electric car looked like it was going to do something tremendously damaging to the old Detroit, but just the opposite's happening. Everybody's picking up that new technology, and those that accept it as a new technology are going to be around for a long time. Same thing with green energy and clean energy. You know, if oil companies around the world don't get it, they're going to die away. Not quickly, but they will die away. But they're already getting into the middle of wind farms and solar and everything else. So they're adapting. So just because the name is the same doesn't mean that it can't be altered over time. But with Bitcoin specifically, if it goes into another hyperwave that runs up to, let's say, $500,000, the big question is, what in the heck would cause it to stop and go all the way back down again? And I can't imagine what that would be unless there's still a cryptocurrency infrastructure, not with 2,000, but maybe with 100 ICOs and alts, and still a lot of stuff about blockchain by the time this hyperwave ends and we start another one. So it's still internally flawed and causes tremendous problems for investors and for regulators. And then maybe you go through, you know, other ones. But what I would rather believe is that if we are able to become a worldwide currency and a gold standard doesn't intervene in the growth part of it, that is, let me just put that aside for a second because that's another alternative. But then I could see an S-curve developing in which everything we've seen, even up to 20,000 with the hyperwave and down to 1,000, is still part of the flat to slowly expanding lower part of the S-curve, followed by a run up to $5 million. And then you're down to the last 1% or half of 1% of issuance. And it's enough that the world economy can function on it. So you then form the top of the S and just go sideways for the next 150 years until something else happens. But the little aside that I just took, the other possibility would be an interim hyperwave where we get up to 100,000 or 150 or 200,000, but not with enough adoption or a big enough cap rate to really affect the world markets. And then because of the macroeconomic problem with credit and debt, which will not be solved by Bitcoin simply going to 100,000 or 200,000 or probably even 500,000, it still won't make a dent. We go to a gold standard, and then that kills the second Bitcoin hyperwave. Then at some point in the future, the gold standard isn't enough to keep governments in check. And then we have the third and final S-curve or third and final movement up in Bitcoin. That's a lot of wild speculation, but I've been thinking about that a lot. Great question.
All right, this is one of our favorites. So and we've talked about it extensively together. So thank you, David. I heard on one of the vlogs that that's true, that you don't trust a lot of the underlying data used on the Bitcoin fundamental indicators like NVT and MVM, but I'll expand it for you, David, as well as on the exchanges and just any of the data coming out. Why is this?
Well, I have a lot of experience with exchanges that trade in very illiquid underlying commodities and or stocks. And the problem with illiquidity is, by definition, not many people are participating. And by definition, some of those participating are much, much larger and much, much more powerful than the average or the many that are participating in whatever that thing is. And because of that, rules can be circumvented. Information can be made available to some, but not to everybody. It's too small for regulators to get involved in. And then, therefore, people in control can make enormous amounts of money at the expense of everybody else. And I'm talking about everything from the palladium markets to the cocoa markets to the sugar markets. Those things that we all take for granted as product. But when you look at what is actually traded on exchanges, it used to be there was just an exchange for cocoa and coffee and just an exchange for cotton, a cotton exchange. That's where, quite frankly, Paul Tudor Jones made all of his fortune, because his family was huge into cotton and then cotton trading. And he had information. Well, no, I'm not going to go that far. It was a very illiquid market that not many people participated in, and he made an enormous fortune and then set up all of his hedge funds based on that. Also, potatoes, stupid old Idaho potatoes. For a long time, 70% of them were controlled by one family, J. Robert Simplot, Simplot. And I used to trade potatoes, which was a subset of an exchange. Now, the reason I'm saying all of that is when reports are given that come out from supposedly the Department of Agriculture on very thinly traded commodities, a lot of the data that was sent into the agricultural dependent was sent in by a small number of people, a small number of families, a small sampling. And because of that, you couldn't trust what the regulatory or the Department of Agriculture reports were doing. Bureaucrats don't have the time to run around and do that stuff, so they rely on third parties to gather their information. The problem with the whole Bitcoin ecosystem in terms of data, in my mind, is no matter where I look, I can't trust the numbers I see coming out of trading volume on exchanges, coming out of do certain places actually hold assets, they say, like Tether? Are the mining costs knowable? Are the amount of things being mined knowable? Can you trust the numbers? Can you trust how many Ethereum or how many Monero or how many Cardano or how many Litecoin? Forget all the other real screwy things. But if I see a number, I just immediately say, who took the pencil to the paper that created that number and sent it out to the public? What is that person's name? Who do they report to? Did they write 3 reports and 2 of them got ripped up and the third one was used? And so I just don't believe any of it. And that just comes from my experience. Maybe that means I'm very cynical. I don't think so. I think I've got my eyes wide open. I trust, to a very large extent, regulated exchanges in terms of price and volume. But I know that price is often manipulated, even on exchanges, and I know how it's done. And I know volume is very easy to manipulate and is often done. But I still trust, in general, those regulators. I assume, in general, in the crypto space, that 95% of the numbers that you see or hear about the number of users, the amount of money, the speed, any of that is false and is intentionally false in order to achieve something for some party. And because of that, I would just prefer to ignore it.
So with so many, okay, how do you narrow down which hyperwaves to focus on? With so many being identified, how do you determine which ones to invest in or to short?
Another great question, and that's why we will do full sessions of looking at hyperwaves and analyzing what I would do and I've done in the past in terms of selection. Right now, we've got such a smorgasbord, it's very difficult. And just because a hyperwave doesn't look perfect doesn't mean it's possibly not the best investment at that particular time relative to all those that do look perfect. But not following all the hyperwave rules, overlaying other trading techniques on it to draw conclusions about the probability of direction and time. So in general, what I'm doing for a number of our clients that are interested in recommendations about where to put that 15% of their money into individual securities, I'm trying to pick out 3, 4, 5 hyperwaves that are either in threes, clearly in threes, but it's questionable if they're in fours or not, to try to get the most upside bang on it. At this point, I've only recommended a couple of shorts, and Netflix happens to be one of them. We'll see how that works out. You know, I know a couple of you guys are trading or attempting to trade Netflix on a phase 6 now. And I have said that I've never seen except that one example back in the 1930s where a hyperwave phase 6 gets back to the old phase 4 high, and only one occasion of that, and it didn't go any higher. It stopped right there, which is a little scary if you were waiting. The good news is if you are playing the phase 6 to the upside, which you should do, the question is, at what point do you want to get out of it? Do you want to just jump out before something horrible happens? Or do you want to see how high it's going to go relative to the old phase 4? Because that's kind of an exciting proposition. If it gets up to the old phase 4 and goes above it, I have never seen that before, and I would immediately say that means you're still in a phase 4. We just had it drawn wrong. And the phase 6 correction, the phase 5 correction simply took you back down to where the real phase 4 line should have been drawn. And we just had this abnormal upswing that looked like a phase 4, but it wasn't. It was still in a phase 3, just with wild swings. And we've seen that on a number of your charts where the phase 3s start going up, and you'll swear they're in a phase 4 because of the angle. And even that angle has a couple of touch points, and sometimes 3 touch points, and then it breaks down, but it gets right back down to the old phase 3 line and then starts back up again. We've got, I think, 3 or 4 of those examples. So the question is, how do you pick all that out? And the best way is what you are all doing, which is finding your own, looking at what others of you have found, questioning where you are in them, asking me what I think, and I'll jump in and give my opinions. Sometimes some of you will agree with my opinions, sometimes not. That's the process, I think, that's the right process for everybody that wants to start trading hyperwaves, is to do that sort of work and look at many, many examples so that at any point when you are actually putting money into one of them, either long or short, you can recall the 10 or 15 or 20 times you've seen different things happen at the same point where you are. Now, from my perspective, when people are asking me, I'm going to pick the cleanest ones that I've seen over and over again to make a recommendation, simply because it's much easier for me to follow them from that point forward and monitor what that person's money is sitting in without having to wonder about the possibilities of phase line shifting or becoming funky or something like that. And there's plenty of examples that look good enough to do that with. So that's kind of the mental process I would go through in terms of selecting.
Thanks, Ty. Are there any particular strategies that should be utilized by smaller bankrolls in order to build a significant trading bankroll to start with? An example would be more of a loose aggressive strategy, since losing it all is not nearly as disastrous as it would be if you had a larger bankroll to start. What do you think?
Well, I would actually disagree with that. The hardest part of building an investment portfolio is getting it started. Because by definition, you've worked for 5, 10, 20 years and you've got X. And X is not usually going to be big enough to do what you want to do eventually. So you don't want to risk X. You want to be careful with X if, let's call it, a smaller bankroll in relative terms. You want to protect that with everything you've got. So the way to do that is to look for the sure things, not the highly leveraged, volatile, speculative things. And what's so unusual about this group in general that Leah and I have come to know is so many of them started out in the crypto space. And in the crypto space, by definition, no one knew it at the time, but it was an all or nothing bet. Everybody thought it was an all bet. No matter what you bought was going to go up, and it was going to go up a lot. And so for years and years, everybody got the reward side of the equation. And that's why the whole idea of Hyperwave ran into so much resistance in the early months when Lee and I first started talking about it, because the listeners, first of all, didn't want to hear it. Secondly, didn't believe it and didn't have any evidence that it was true. Because the previous little tiny bitty hyperwaves, it seemed awfully big at the time as percentage gains, after they ended up going all the way back down, or most of the way back down to 250 or down to 100 or down below 100 on the earlier ones, ended up getting right back up to 1,000 again, then ran up to 20,000. So it was very easy to dismiss. Every week and month that has gone by, I believe that people are beginning to understand that all asset classes, including in the crypto space, fall into the same category of running into the problem between greed and fear. And when fear takes over, prices can go down for a very long way, and Hyperwave is one way of measuring that. That's an important lesson for everybody in the space to learn. But it is not the place you start investing. That's the place you end up investing by putting 15% of a large bankroll or a large portfolio into something like Bitcoin and crypto. This is ass backwards for many people in this space. They took, small amount of money relative and put it into the most volatile thing in the world that turned out to have a rotten to the core infrastructure, which is now they're paying for it because they came to the conclusion, well, if I lose it, I lose it. So my answer is, you want to be careful with small bankrolls. You want them to grow into medium-sized bankrolls and then take part of that medium-sized bankroll, and then you can get more aggressive. And hopefully you've learned enough techniques when you're getting more aggressive that you know how to protect yourself. It doesn't help to be aggressive and not understand options or futures, financial futures that you can protect positions with, or consensio that you can see incrementally when you need to begin starting changing your mind about where you are. But if you do that, this is the time to be learning all of the techniques so that when it's time for you to get aggressive, you can protect that aggressiveness without hurting your small bankroll or half of your medium bankroll. And now you can turn it into a very large bankroll in the next year, the next 3 years, the next 5 years, the next 10 years, the next 20 years. Remember, one of the adages that I like to use, because I'm 69 years old now, and I started this when I was a late teenager, basically, not professionally until I was in my mid-20s, but I started getting interested in this kind of stuff, is there's always another train coming. Don't worry if you miss this train. You would have been lucky if you had missed this Bitcoin train in August, September, October, November of last year. Yeah, it was a fun ride. But if you didn't know what you needed to do, you've had a horrible 10 months. And you've given back almost everything that you put into it. And if you got in November and December, not only have you given back everything, but you've also lost part of your bankroll. So what my point is there's another hyperwave in Bitcoin coming. So be patient. But the bigger question is, on these other hyperwaves, take your time. Don't put all of your money in one or two or three of them. Put a little bit of money into 1, 2, or 3, or 4, or 5, or 6 of them, and then watch them. If you've actually got the right ones, you're going to go up 10 times your money, depending on how early you got in, and definitely 10 times your money if you also take the opposite position in 5 and in 7 by either shorting it, in which you're making money, not just protecting assets, but making money on the downside. You should get to the point where you can make money all the way up and make money all the way down, with a couple of hiccups along the way that you can protect by using consensio or by using options or by putting in very close trailing stops. So that's the long answer to the question. No, don't blow what you've got now on something that looks really good. Take a portion of it and prove out how good that thing is or not. Now you've got more money. Now do it a second time and then a third time. And then after about the 100th time, you're going to have a nice bankroll. But that's the kind of discipline you need to do this stuff correctly over a long period of time.
Thanks, Mr. I almost said Mr. T. You guys need to stop getting in my head. Okay. Thanks, David. I like this. Ready, time?
Yeah, sure.
All assets rely on two components for price discovery: supply and demand. Since Bitcoin supply is mathematically predictable, do you think that forecasting its price action going forward will be more accurate, since demand is the only unknown variable?
Yes, but not when there's 2,000 things that people mix up as either being as good, if not better than Bitcoin. Better not meaning qualitatively better, but better being because they're more volatile, you can make more money being in them. One of the biggest drags on Bitcoin is the problem that the supply is not limited. The supply is theoretically limited, but that supply that is tradable, which in other commodities or in stocks is called the float. The float is the difference. Let's talk about stock. IBM has what is called treasury stock, which sits in their treasury at IBM and is not publicly traded. They can come out with it at a later time. It's already been authorized, but they're holding it. Then there is the amount of stock that the public is trading in. But what people keep forgetting is there are also very large institutional investors, people like Warren Buffett, who will put billions of dollars into something, Coca-Cola or now Amazon, whatever it is, and they are not going to sell that. Theoretically, that is float because it's publicly held stocks that could be sold, but they're not. They've been taken off the market. In Bitcoin, the amount that is hodled by whales is not float. It's not available. But it could become available, particularly as prices are dropping to the point that some of the very big ones are forced to sell. And that includes institutions and hedge funds and other things. So it's not as simple as there's only two elements, supply and demand. What's more important is what elements go into supply and demand. And one of the biggest things about the demand side of the question is the amount of acceptance Bitcoin has in the world. We know it's zero now, 1/10 of 1%, whatever you want to call it. I don't trust that number because I've already explained that. But let's just say the amount of acceptance of Bitcoin in the world is negligible. So that's the big part of the demand function, is the potential for it to become acceptable. And that's a huge, huge number potentially. But if it does not become acceptable because of all the nonsense going on in the ecosystem, confusing the regulators, and the regulators do all kinds of stuff, they could kill the whole thing off so that there is no outside demand anymore, which is what a phase 7 of a hyperwave is saying right now. Okay, but the other side is, let's just assume that that demand function is almost infinite. It can go from 1/10 of 1% up to 100%, which is a huge, huge number in the trillions and trillions of dollars. So that's exciting. And it is also true that there's going to only be 21 million of these things. But it's a little bit different because the 21 million, depending on the three scenarios I lined out about the next hyperwave and maybe a third one beyond that, and maybe an S-curve, all of those will be determinative in terms of how that supply of 21 million are being used. Are they actually being held, or do they become supply back into the market because of what's happening with price or a gold standard or other things? So I think it's really a lot more, oh, that's cool.
You saw that I launched a poll.
Yeah, I see that, but I don't see how to answer it.
Well, it's not for you.
Oh, it popped up on my screen.
Yeah.
So it's a great question about supply and demand. I don't think it's quite as cut and dried mathematically as we'd like to think, that if there's only 21 million of something, that is determinative of much higher prices. 21 million Beanie Babies turned out not to be determinative. 21 million pet rocks turned out not to be determinative of higher prices. It did for a little while because of games people were playing, but 21 million can turn out to be way too many if acceptance doesn't come about. if you stipulate that acceptance comes about and Bitcoin hangs around for a long period of time, that the tendency will be for prices to go up because of the limited nature of the 21 million. I would agree with that. But I wouldn't make all the jumps to get there at this point.
Thanks, Ty. And thanks, everybody, for playing with me on this. And the poll said 2 more questions for you. I didn't allow more than that, but I could have, guys. You can send another question. So this is a bit long, so I'm going to read it, the full thing. And Tyler, just let me know if you want me to read it again. Don't you think that since central banks continuously artificially dilute their respective currencies, this causes financial assets such as equities to be artificially inflated in turn? Are they prudent investments still? Question mark. How long do you think the U.S. equity bull market will last? Question mark. Isn't it already the longest ever? Last question.
Great question, but it's based on one misstatement earlier on in the question, but we'll get back to that in just a second. It's a great question. Yeah, central banks, if they keep interest rates low for a long period of time, they're not, that in itself isn't printing money. What is printing money is what the Federal Reserve did in the United States, which was to buy bonds with no money up to the tune of almost $5 trillion, $4.7 trillion. Now, they did not, as a central bank, go to one of the Federal Reserve banks in the system and say, we'd like to take out a loan to buy these bonds, which is what you and I have to do. And I can get to that in just a second, because that's the mistake, I think, in the assumption you made in your question. And I'll get to that. But what the Federal Reserve did as our central bank is they simply began buying bonds, starting with U.S. Treasuries and then moving into mortgages. And I think they even bought some Ginnie Maes and Fannie Maes. But they also bought 30-year bonds and 10-year bonds and 5-year notes. What did they pay for? What did they pay to make those purchases? The answer is nothing. What they did is they simply made an entry onto their balance sheet that says they owed this amount of money, which is the amount of money that they wrote checks out of against a zero balance up to the tune of $4.7 trillion. They got something in return, which is they bought bonds from the marketplace with those checks. So now they own the bond, and that is pressure on the price of bonds up because they're buying bonds. Therefore, they are bidding, like we just talked about Bitcoin, supply and demand. They become a demand function for bond prices, which make prices go up and causes interest rates to go down mathematically. And you've got to understand that that's the way bonds work. It's perfectly inversely opposite to the price of the bond, the percentage drop in the interest rate. So the Fed did not force interest rates down. They bought bonds which by their nature, by driving the price up, caused the yields to go down. That's different than what their mandate was, which is they actually can physically lower the Fed funds rate. That's the only interest rate they can do. It's a 24-hour rate between the Federal Reserve and Federal Reserve banks. And then the Federal Reserve banks get that money at that rate, which was zero. They called it 0.25%, but basically it was zero. So the San Francisco Federal Reserve Bank could borrow from the Federal Reserve as much as they wanted, $100 billion. And $100 billion would go from the central bank to that San Francisco Federal Reserve Bank, and that Fed bank had to pay zero to get it. Then that Federal Reserve Bank in San Francisco goes to the public and says, we've got money that we will lend, and we'll lend it to you at 1% or 2% or 2.5%. So now the banks, Bank of America, JP Morgan Chase, regional banks, can borrow from the Federal Reserve at very low interest rates, which then means those banks can turn around and lend them out to stimulate the economy. Or they can lend it to institutions that, if they only paid 1% to get that money, can then buy stocks that are yielding 3% and make a 2% arbitrage for free. That's what causes the bubble. It's not the central banks doing it. It's that the transportation of that money through the system ends up with people that can put it into stocks, into bonds, into real estate. And that's what caused the real estate bubble, because of the differential between what you can borrow from and what you can get on the other end. And that's why people say it's printing money, because you and I could be doing that if we had a financial institution that was borrowing from the bank and you had a good line of credit. They could give you money. You could take that money and not put it in your company, not spend it on cap research or anything else, but take it and put it in the stock market. And that's what a lot of financial institutions have been doing for the last 10 years, which has caused this big movement up. Now, Leah, would you just read the beginning of that question again? Because there was a statement in there that I want to talk about for a second.
Yes. Don't you think that since central banks continuously artificially dilute their respective currencies, this causes financial assets such as equities to be artificially inflated in turn? I'll just continue the whole thing anyways. Yeah. Are they a prudent investment still? Question mark. How long do you think the U.S. equity bull market will last? Question mark. Isn't it already the longest ever? Last question.
Yeah, it is the longest ever. Yes, I do believe it's going to last for at least another year or two. But going back to that beginning part, the Federal Reserve actually, through that transmission mechanism that I just described, said in public in the FOMC meetings on a couple of occasions, or at times Bernanke said it, Yellen said it, Powell has not yet said it, but they said this will help support asset prices. That's code for we are artificially going to support asset prices through these various mechanisms that we are doing, that were never given to us as a mandate anytime until Alan Greenspan started experimenting with it after the dot-com bubble break. And now has grown much, much bigger with all kinds of different ways of doing it to get to the same place, which is to make cheap money available to financial institutions so they could make money, and therefore they could lend more money, and those borrowers that are getting that money cheaply can spend more money. So if that's what you meant by artificially supporting it, I would agree. In terms of diluting the currency, which was the first part of that question, that is not a direct result of that transmission of interest rates. It happens, and where it really happens in my mind is all the way back at the central bank, the Federal Reserve at the beginning of the process, where they can buy bonds in the marketplace, meaning off of an exchange, through the U.S. Treasury without paying for it, simply putting an IOU on their balance sheet. What that just does is that creates artificial money at the beginning of that process. It's not the supporting of assets through low interest rates that does it. It's that funky thing that they started doing where they went up to almost $5 trillion. And so the assumption is, could they do 10 trillion? Are they now in a position in terms of power where they say they've got to do 100 trillion? And what about all the central banks in the world working together using the same techniques that our central bank experimented with and now has been transmitted throughout the world through central banks? So the reason for my skepticism about not this year, probably not next year, going into maybe 2020, is the credit debt problem has not gotten smaller, it's gotten bigger, which means that the solution to the last 06, 07, 08, 09 problem was much easier and required much less money than the one that we are now sitting in. Now, can that end next Monday? Absolutely. Do I believe it's going to? No. Because Consensio and all the technical stuff that I follow said for the last 8 months, things got dicey, not only in this country, but around the world. But now it's gotten less and less dicey, not more and more. So as indexes continue to break out to new highs in this country, Europe should begin to respond. Now, I haven't heard, maybe some of you have, supposedly today, Canada and the US were going to come to an agreement on NAFTA. Maybe they already have and I just didn't see it, but maybe later today they'll announce it. That means that Trump won on Mexico. They will have brought Canada into the fold, which looked impossible. I believe at some point, China is going to yell uncle. And Europe has been resisting and all of that, but one by one, things are going to be worked out, I believe, in terms of the trade thing. And that will get us over a huge hump that I think will accelerate things for the next year or two. But, okay, so that's the long answer.
Thanks, guys. Ty, we have two more. Gabriel, I'm going to start with yours and end with yours, Jay. So in our episode titled The War Against Bitcoin, Fiat, and Gold, which was good fun, and if everybody remembers, actually we had Saifedean on the next episode. But you had mentioned that you believed a financial problem is imminent, which is orders of magnitude larger than 2007, 2009. Please have fun and elaborate on that for us, Ty.
Yeah.
Well, it's not so fun that, it would be a financial crisis, but yes.
Yeah. The imminent part in that case means it's absolutely got to happen unless a solution is found. And I offered 3 solutions, all of which will work, all of which will have very negative ramifications. The one that has the least negative ramification is Bitcoin. The one that has the least possibility of being accepted worldwide is Bitcoin. The next one that would be incredibly disruptive, and I've been trying for months, possibly years, to figure out what will the disruptions be, and it would be fun for all of you to think about this. Let's assume that we get a new Bretton Woods. Maybe it's totally in secret. It's not public like the last one was. And it's going to occur 2 weeks from today. And it will have all of the major players attend the way Bretton Woods did. I think, first of all, that's very possible. I think it's going to be more and more probable that that's going to occur. Let's also assume that coming out of that, let's say a 10-day conference, it ends on a Sunday, and there's a declaration overnight, Sunday night, that the world is moving back to a gold standard. Or let's put it more probably, that the attendees have all signed an agreement that says we're going to move back to a gold standard. Those that didn't attend, or the minority that attended and didn't sign, aren't going to be held party to it. But let's just assume all the major players sign off on it. I think that's a very probable outcome. If that were to occur, I believe that the price of gold has got to be approximately $10,000 an ounce. And so if it's announced on a Sunday night, on Monday morning, gold would be closed in terms of trading worldwide. But when it was no longer closed, it would start trading at $10,000 an ounce. Now, that's $10,000 an ounce relative to US dollars. It's different amounts for everybody with different currencies. Some a lot more, some a lot less. Our debt is delineated in our currency. You owe $6,420 on your car. You owe $125,000 on your mortgage to your bank. What we've just done is we have, because the dollar is now pegged to gold at $10,000 an ounce, we have just devalued currencies around the world relative to gold. No longer relative to the dollar like it was at Bretton Woods. What does that do for the amount of money that people owe? And more importantly, for the creditors on the other side. How's that going to be handled? Coming out of World War II, where everything was totally destroyed, you're basically starting at a base of zero. Here, we've got just the opposite. Enormous debts and enormous credit and huge amounts of bonds. So what happens? What's the fallout of all that? That's a very complex question. The third possibility, besides Bitcoin and going to a gold standard, is governments begin defaulting on their debt. They simply say, the amount of money we owe you, we owe the world, we owe bondholders, we own sovereign bondholders, we own the banks that have borrowed from the Federal Reserve banks that have borrowed from the Federal Reserve itself. All of that money where we owed X, we are only going to be able to pay 0.5 of X. Everything else you got to write off. That's what default means. It means that those people that lent money to their countries by buying their sovereign debt, or those people that loaned money to their, were loaned money for their children's education, on and on and on. Take it through everything where money changes hands as a basis of credit. Money that's owed on a credit card, money that's owed on a mortgage, where you have, it will be paid off, but only at 0.5x. What does that do to the world economy? What does it do to individuals? What does it do to people on the other side of the equation that are going to get unbelievably wealthy overnight, and those on the other side that are going to be destroyed? That's where we are in world macroeconomics. And it will either happen because it's forced through default, because money simply is not available to make payments the way it is in Social Security or Medicare. There is no money in the pot to pay people that. There is no money in the pot to pay people Social Security. The only reason I receive a Social Security check is because you're paying me. It's not in a pot in Washington that I get my check every month for. It's because it's coming out of your pay, and it goes to Washington and immediately comes to me. There's nothing left over. There is no trust fund. There is no lockbox. There is no money in it. So as soon as you can't pay what you are supposed to pay in terms of employment taxes, I don't get paid. That's where we are. That's why this discussion about Bitcoin and a world currency or a gold standard or default is so important. We've passed all the tests up to this point by playing games, which has made the problem worse.
All right, Ty, this is fun. Jay is going to ask your next question. Thanks, Jay.
Oh, great.
Hey, can you guys hear me okay?
Yeah, perfect.
All right, great. It's working. Okay, I'll just ask it. Tyler, would you pull any money or any percent of money out of the markets if, for example, the new tax laws look like they would be rolled back due to political power shifts in the United States? Basically, do you or would you look at any outside events to pull money back before Consensio would normally dictate or stay with the system?
The answer is no, because Consensio will pick it up immediately. What I mean by that is the thing that would cause what you just said would presumably be either impeachment or the upcoming elections in November, in which the Democrats take over one or two of the houses and then can start impeachment proceedings and then possibly mess up the presidential election so that someone would be in a spot to roll back the tax things. Well, all of that stuff has a lead up to it. As you get closer and closer to the November elections, the polls will become clearer and clearer, but everybody will still remember how clear the polls were going into the presidential election and how they turned out to be absolutely wrong. And people know that. Therefore, the poll strength is not going to be that great no matter what it says as we get up to election day. But people will start voting with their money as they expect an outcome, and that will show up in Consensio. It'll show up in prices, and we will see deterioration so that we would probably be out long before the election even takes place, with the possibility that we've only gone through, a couple of the early iterations of Consensio, where maybe the short term is down through the intermediate term and maybe even down through the long term, but price is not yet down to the long term, which is still going up. So maybe we've taken 25 or 30% out of the market. Now, two things can happen. On election day, the polls turn out to be wrong and the market skyrockets up. And you've lost opportunity on the cash you've taken out. Or the polls turn out to be right and you've already taken the first step and you've taken money out of the market. It's sitting safely on the side. And now on the following Wednesday morning, if this is a Tuesday election, which I believe it is, the markets begin to tank. Well, you've already set up with the short-term moving, average moving down, the price moving down, short-term through the intermediate term. The intermediate is slowly turning over. So now you can move very, very quickly and simply step aside, make the assumption at that point that this will continue, which is what I will do with my discretionary clients in something that black and white, because to me, that's a very black and white possibility that I'm already considering. The other side, which is what I think is going to happen, is Trump and the Republicans are get stronger and stronger between now and November. And the market's going to recognize it, and we're not even going to come close to having these trends stop as we go into the election. And then after the election, they're going to go crazy, and the Democrats are going to be jumping out of windows, and Trump is going to, have a bullhorn out. And the world's money is going to start pouring into the United States faster and faster. So but I hear what you're saying. And the question is, does it ever make sense to front run Consensio? And the answer is absolutely. You want to front run Consensio on strength, not on weakness. You don't want to front run Consensio in a bear market, trying to anticipate that's going to turn around. You want it to turn around and prove itself before you put money at risk. In a bull market, you've already put your money in. So this would be the time to front run Consensio if you've got great profits you want to protect. You just, for political reasons or other reasons, think that things are not looking like fundamentally you assumed that they were going to be. So front run it. As soon as the short term and the price turns down and touches the mid, get out of 50% of your holdings. What are you risking? You're not risking money. You're only risking opportunity. And you've heard me say over and over again, to me, there is no way you can call that a 50-50 bet. It's 3-1 in favor of doing that as opposed to not doing it. Because if you don't do it and you're too late to the party, or you don't know Consensio, or you buy into this crap about buying and holding blindly forever, the way so much of Wall Street and John Bogle and others tell you to do, then you are risking money. And you've only got a limited amount of that. You've got an infinite amount of opportunity. You've got a very limited amount of money, and that's the difference.
Thank you.
Oh, thanks, Jay. I cut you off there. Sweet. This is so good. Guys, thanks so much. Ty, I think that we're going to have to end it here. It's 5:15.
That's great. Thank you, everybody. That's fantastic. And Leah, thanks for working out all these details. It's going to make the webinar go so smoothly.
We'll see on that. Actually, thanks to you guys you have no idea how many back end I was guys, is this working? So, okay. So yes, I'm going to download it, upload it, and then it's going to be visible for you guys privately. And that's the next step of what I'm trying to learn. So guys, thank you so much for this. Jay, thanks for everybody. Thanks for helping us out with this one. Mr. Ty.
Great. Thanks a lot, guys. And thank you so much for all the work you're doing in the Hyperwave channel. I love it.
Yeah. All right. Bye, guys.